Hey traders, Ron here, Traders Academy. And as you know, it's our goal to coach and train traders of all levels. Typically we do that through our podcasts, our blogs, our meetups, and our webinars. But a few weeks ago we had the idea to put out through social media a question to all of you asking, what is your biggest challenge or obstacle that's preventing you from creating consistent trading results? And the response was overwhelming. So what we decided to do was take those responses and create a series of mini courses, each one answering a specific response. So we hope you enjoy these, hope you find them informative, and thanks for watching. Welcome to mini course 5, entitled Futures and How to Trade Futures in Large and Small Accounts. And this will be part 2 of our 4-part series. And our question was, I really feel more comfortable trading commodities than I do stocks. But I have always been told that they are very high risk, and I only have a small account, so I've never really gotten involved. How should I begin if I want to trade futures, and is there a way that I can trade without having the excessive risk associated with futures? Any help would be great. So again, I want to say that the futures market is by far my favorite market to trade. But at the same time, I'm a firm believer that to be fully and properly diversified, you need to maintain positions in all 3 major markets, and that would be equities, forex, and futures. And by doing this, you'll be much better placed to offset the wild market swings in the equities market. So don't give up on the other 2, as you'll need them just as well. But now to be more specific and answer your question. So the first part of your question was asking how should you begin if you want to start trading futures. So let's work on that part first. Let's first start with the standard method practiced by most futures traders, and that is either buying or selling, which means going short, a futures contract. And this will of course require some decision making on your part, and you'll have to have a system that will enable you to research and determine if there is a commodity that should either be bought or sold. Now this can be done in one of 2 ways. The first being good old-fashioned common sense. If you just keep your eyes and ears open to any global events, you should be able to identify certain types of events that could signal either a buy or a sell of a commodity. For instance, if the East Coast is having an above-averagely cold winter, then that should tell you to look at natural gas, as cold temperatures will require more heating and natural gas is what is used most for heating. Another might be, since we all have cars, then it shouldn't be too hard for you to identify trends in the price of gasoline. And that should allow you to make a decision on whether to either to buy or sell crude oil. Or maybe you've just been keeping a watch on events in Europe, maybe the EU economy or maybe the Brexit progress. And if you saw the EU economy declining, then you might look to sell the euro. Or if the Brexit deal was not looking good, then you might want to sell the British pound. So I think you get the idea. By just keeping yourself aware of global events, you will get great insight into how these events can and will affect the price of specific commodities, therefore allowing you to buy and sell the associated futures contract. Now, another method of determining a futures trade is to use technical analysis. So for this mini course, I will not go into how technical analysis works and how specific chart indicators work, but I've covered these subjects in other mini courses, so I encourage you to go back and watch those. But using the charts is my preferred method to trade futures contracts. In fact, even if you end up using the first method, which was more like fundamental analysis of just following global events, you'll still have to use the charts in order to determine the level of risk that you would be taking if you did enter the trade. So you will have to become skilled in either the reading of charts and the indicators used before you can safely start trading. But don't let that scare you, because this is something you will have to master to safely do any type of trading. So let's now assume that you're ready to actually place your trade, and this brings us back to the subject of how much risk you want to take, and that was actually part of your question. So the reason this is so much more important with trading futures and other types of investments is because of leverage. Because all futures contracts are so highly leveraged, as we discussed in part 1 of this series, you will need to take special care to determine your risk before you ever place your trade. And the way you're going to do this is through the use of technical analysis. So this brings us to the point to where I will switch over to our actual trading platform, which is Thinkorswim, and actually go through a complete example on determining your risk up front and then placing the trade. Okay, we're in our Thinkorswim platform, and I happen to have up here a chart of live cattle, symbol /LE, and prior to starting this video, I researched several other charts, and this is the one that I felt was most suitable for doing a trade for this example, and actually for doing it in reality, for real, which I'll be doing. So we're looking at, like I said, live cattle. Now there are some specifics about futures contracts that you need to understand prior to placing any kinds of trades, and those are basically every futures contract moves in increments, and those increments are called ticks, and then every tick increment has a value for you, either positive or negative, whether you're long or you're short, or whether it moves up or down, for each one contract. For instance, for the one we're doing, live cattle, right here, LE, each tick movement is equal to 0.025. So every time it moves up or down 0.025, that's one tick. And every time it moves 0.025 up or down, that is equivalent to $10 profit or $10 loss, according to which way it goes, for every one contract in your account. And then also, every time you put on a futures trade, and they're all different as you can see here, but in this case you have margin requirements. So for putting this one on for live cattle, for every one contract, your margin is $1,980. So you have to have that $1,980 in your account free and clear in order to even place the trade. So again, futures contracts move in ticks. In this case, a tick for live cattle is 0.025. Every time it moves 0.025, that is $10. If it moves up, that's plus 10. If it moves down, that's minus 10 in your account. So now that we have those factors, and by the way, I'm going to do a little spreadsheet for you in the actual mini course showing you all this, so you don't have to be writing it down. So now we know our tick size, we know our tick value, and we know our margin requirements. So now we have to use the indicators that I have on the chart to determine what it is that we are actually going to do. So the two indicators that I have on, first off, are standard deviation channels, +1 standard deviation, -1 standard deviation, +2 standard deviations, -2 standard deviations. And how I use those are pretty much in every case, anytime price action hits either +2 standard deviations or -2 standard deviations. And when I say hit, I mean gets really close. I mean, it could hit, but close or just close to it. The price action tends to reverse and head the opposite direction, like we saw here. We got all the way down to almost -2 standard deviations, reversed and went the other way. Now we are sitting at +2 standard deviations. So it's my theory, and based on technical analysis, it's indicating that we are more than likely now to move off of that and start moving back down. So that would indicate that this is a perfect time, somewhere in here, to sell a live cattle future and look for it to move back down. The other indicator that I have are parabolic SARs, which I did describe those in the mini course 4. Basically how that works is if the dots are below the candles, that's an indication to be long, and if they flip and from below to above like they did here, that's an indication to go short. So with our parabolic SAR flipping to above the candles, that's saying go short. The fact that we hit +2 standard deviations, that's another indication to go short. So both of these indicators now are confirming the same thing. So I feel this is a very good time to actually go short this futures contract. So now what we have to do is work the numbers and see, because remember your question was how to manage your risk in trading futures, because they are so highly leveraged, and because of that high amount of leverage, the risk is also high. So what we want to do is, another function of the SAR dots is, like in this case where the dots are now above the candle, that is on the last dot, or the most current dot, that is where you're always going to want your stop to be. And as this trade progresses, like we saw here, the dots progressively move up with the trade, or in this case they'd be moving down with the trade. So we know that our stop is going to be at that dot. And so if we entered the trade right now, entered it short, sold the contract, we would be getting in at about 125.72. And again, I'm going to put all these numbers on the slide presentation. And we know that our stop would be at 127.89. So then if we did the math on that, we would know that we have the distance between where we would enter and where our stop loss would be 2.17. So now, knowing that our distance is 2.17, now you want to divide that and see how many ticks there are in that number. So we would take the 2.17 and divide that by the 0.025, and that would give us 86.8 ticks. And remember, each tick value, we can look up here again, 0.25, and each tick value is $10. So if that was the case and we had 86.8 ticks before we hit our stop, that means we would have a value, a distance in terms of dollars, of $868 before we got stopped out. So that's telling us that our maximum risk for this trade would be $868. So now we want to figure out the potential profit. And to be safer, let's assume that we may only make it as far as this level of support here, which we had also determined was about 120.21. So then if we take our number where we would enter the trade, where we would sell this contract at, that again was 125.72. And if we subtract the number here of 120.21, that will give us a distance of a possible first leg movement of 5.51. So once again, we want to see how many ticks are in that number. So we take the 5.51 divided by 0.025, and that tells us that we have 220.4 ticks from here to here. So times that times 10, and we have a possible profit level of, or gain of, $2,204. So basically, if we short the stock here, and it does make it all the way down to our first level of support, we stand to make about a little over $2,200, risking $868 to put the trade on. So pretty good risk to reward ratio. So with those numbers and with that in mind, I feel it's good. It's a good trade to place. So now we would go up to trade, type in /LE, go to our active contract. It says active right there. Right click, sell a single, and let's knock this price down a bit so that it's more likely to fill for us. Make that good till cancel. One contract, and let's send it off and see if we fill. Okay, it is up here in the working orders waiting to fill. As soon as that fills, we'll be able to go in and place our stop loss order, and we'll be good to go. Okay, we have a fill. As you can see, our order is now in the filled section, filled orders. So now the last step is to place our stop loss order. So you would open up your trade. If you remember, the number that we had for our stop loss order is 127.89. So you'd right click on the position, create closing order with stop. Click that and come down here, and we are going to put in 127.89 and make that good till cancel for the one contract, LE. And we need to have that in even 0.025s. So I'll click it down one. There we go. So send. And now we have our closing order, or our stop loss order, at 127.875. And we are good to go. Now the only other thing you would have to do on this trade is, remember, each day on the chart there will be a new SAR dot, and each time one of those new dots appears, you will need to come in here and right click on the closing order, cancel and replace order, and then edit the number here for closing your stop loss order, and edit that number to match what the most current SAR dot is reflecting. And that you would do each day. And other than that, your order is there. We are good. Our max loss, as we determined before, is $868 if it does go against us and it hits our stop. And our first profit target would give us a profit of $2,204 if it makes it to what we determined as the first level of support. Okay, so I hope that live example helped you understand a little better how to place an actual live futures contract trade. Again, this chart, these are the numbers that I referred to while we were going through that exercise. So possibly use these numbers on this chart and go back maybe and listen to that section again and have these numbers in front of you. That may help you understand it if you were having trouble before. Otherwise, remember that these numbers are specific to live cattle futures only, and they're going to be different on other futures contracts. So the tick size, the tick amount, all those things, the tick value, all those things are going to be different for each futures contract you look at. So just keep that in mind. So this concludes part 2. We covered the basics of what's involved in doing your research, either fundamental or technical, or maybe both, and using that information to decide on a commodity futures contract you either want to sell or you want to buy. And then we covered how to use the charts to determine what your max risk was going to be, and how to use a stop loss order to limit your risk. And now this covered the direct trading of a futures contract. This has the most risk because it has the greatest leverage. So in part 3 and 4, we'll look at how to trade the same futures contract, but in much smaller account with much less risk. So we'll see you in part 3. But in case all of this seems too large of a task for you to take on, I would like to suggest another option. Instead of taking all this on by yourself, you should consider coaching. Coaching is something that's used by every successful professional, and at the same time, something that's almost never thought about for the average person. But think about it for a second. Pro golfers have coaches, pro boxers have coaches, sports teams have coaches, pro skiers have coaches, actors have coaches, even rock bands have coaches. And the list could go on, but I think you get the idea. And one of the things you may not know is that traders have coaches too. In fact, I can promise you that all successful professional traders have coaches. All large brokerage firms employ in-house coaches to support their in-house traders. And matter of fact, when I worked on Wall Street, I used their in-house coach all the time. Either way, whatever path you decide to take, I just want to encourage you not to give up on your dream to become a trader. There's not another business in any field that has the potential to produce the kinds of gains possible as a trader. Remember, it's all about following the process, breaking it down into workable sections that you can tackle with ease. And remember, if you don't feel like going it alone, consider coaching. We want to thank you for watching. We hope you enjoyed it, and hope that the information that you got can in some way help improve your trading. And if you'd like to watch the entire series for free, all you have to do is go to tradersacademy.org. That's tradersacademy.org. Fill out the form, give us your email address, and we'll send you a link to the entire series. Plus, we'll give you a free copy of our Reprogramming the Trader's Mindset book, and we'll give you access to a free 1/2-hour private coaching session. So if you'd like to take advantage of this offer, again, that's tradersacademy.org, tradersacademy.org, and thank you for watching.